Now I would like to welcome Ms. Vaida Madam, Assistant Director, IABF, to introduce Speaker of the Day, Mr. A. Thiruma Valavan, Deputy Director, IABF. Welcome, ma'am.
Thank you, ma'am. A very good morning to all the dignitaries and the participants. I, Mahita, take pleasure in introducing the next speaker, Mr. Thiruma Valavan, Deputy Director from IABF. Mr. Thiruma Valavan had more than 27 years of experience in the banking and finance, heading various branches of Canara Bank in rural, semi-urban, metro, and also worked in administrative units like regional office and head office and training setup. At present, he is working as Deputy Director IABF Mumbai. His education qualifications are CIIB, MCOM, MA Sociology, MCA, MBA Marketing, MPhil at Entrepreneurship. Other specialization certificates, he has Customer Relationship Management from IIM Bangalore, Digital Competition in Financial Services from Copenhagen Business School, Financial Development and Financial Inclusion from International Monetary Fund Institute. He has extensive experience in credit, NPA management, accounts and audit, marketing, IT and cybersecurity, and financial inclusion. He worked as divisional manager in the regional office Madura. Further, he was also principal at Canara Bank Regional Staff Training College, Madura. His research papers have been published in a variety of reputed international journals. Name a few are Challenges in Business Correspondence Model and Empirical Study, Financial Freedom through PMJGY, Success Story of Canara Bank by Innovative Implementation of Financial Literacy Plan and Empirical Study, Developing the Next Generation of Economic Citizens through School Banking Champs and Empirical Study, Financial Awareness of the College Students in Rural Areas and Empirical Study, Mission Mode Objectives, 36 Pillars at Financial Inclusion and Empirical Study with special reference to Canara Bank, a combo scheme of PMSBY and PMJBY, the success story of Suraksha Bandhan. Now I invite Mr. Thiruma Valavan to deliver his keynote address on the theme FinTech 2.0, the new epoch of financial inclusion. Welcome, sir.
Thank you, madam. Good morning, dignitaries, and good morning, every participant. So in this session, we will discuss on FinTech 2.0, a new epoch of financial inclusion. So in this discussion, we can touch upon three main things. One, how banking has evolved in the recent past and how it is going to evolve in the future. That is one thing. And another one, what is financial inclusion and how it is going on, how it is going to happen in the future. The third one is the impact of FinTech companies, how it was earlier and how it is going today, and how it is going to disrupt the banking business in the future, and how it is going to help the financial inclusion. So with these three things we are going to discuss in this session. Some 20 years back, when I was working in a bank, there is no such computer. Every work were done manually, whether it is passing a check or issuing a draft or collection of a check, everything was done manually. But nowadays you might have seen in the bank, everything is going on in a digital mode by use of computer system. So a lot of things have changed. To understand all these things, we will see two important words. One is banco and another one is new bank. If you are able to use the chart box, you can share the meaning of banco. So how it has started in the past, we will see the history of banking, small a.
Bank, a term that has become an integral part of our lives. From saving money, booking online tickets, taking a loan, to any other money-related operations. Banks have become the bridge that connects us with money. But how did they come into existence all of a sudden? Let's turn over the pages of banking history. The first banking system was started in Italy. In the Middle Ages, Italians used to carry out their commercial trading and transactions sitting on a bench. In Italian, the word banco refers to a bench. With the intervention of many clients and customers, the word banco underwent changes and became bank. Technically, banking system was started right in the Paleolithic age with the advent of barter system. People exchanged and traded goods they already had for things they needed. It was beneficial up till the point when people felt that they required a common commercial tool for trading. As gold was commonly used by everyone, people started using gold coins as a trading tool, which led to the birth of banks. The inception of banks was mainly due to two kinds of people, the merchants and the goldsmiths. The traditional banking system was initiated through the concept of safe deposits. When the merchants traveled all over the world, they needed a place to safeguard their gold coins. Hence, they approached the goldsmiths to store these surplus gold in their safety vaults. This is how safe deposits came into existence. When the money was idle in the safety vault, the goldsmith started lending it to people, earning an interest from it. He also gave a part of the profit to the merchants as an incentive, encouraging them to deposit more gold coins with him. This paved way for the savings bank or deposit scheme in the later stages and is still considered to be one of the safest investment plans. These can be rightly called the stepping stones to the conventional banking system. The world's first bank is the Bank of St. George in Italy, which was founded in 1407, whereas Monte dei Paschi is the oldest surviving bank since its inception in 1472. With technological advancement, the whole banking process is now confined to small mediums like computers and mobiles.
So in the early stages, there were branches, and after the introduction of the technology, the branches started connected with the branches at the bank level. The computer started connecting the accounts of one branch with the accounts of another branch. The concept of the branch was lost and the concept of the bank has emerged. So earlier what happened, a person having an account with a branch, they can go to that particular branch and they can do the transactions. They cannot do the transaction from different branch, or they cannot transfer the fund to anyone in a different branch. But due to the introduction of the technology and all these things are happening, that has reduced the gap of a lot of things, and that has enabled the financial inclusion as well. The next step we are seeing in the future is neo-banking or digital banking. Even Reserve Bank of India has a proposal that introduction of digital banking in India. And in the digital banking or neo-banking, what happens, the physical presence of branches will not be there. So there will not be any physical presence of branch, and the customers can open the account on their own, and they can do the transactions on their own and using the internet and mobile. We'll see a small area regarding that.
Neobank is entirely online with no physical branches and offers digital-only financial services. As a direct bank, Neobank reaches customers with its mobile-first financial solutions. Considering the tech-savvy and the underbanked population, Neobank is predicted to surge to 98 million users by 2024. It has become increasingly popular due to its innovative banking and financial services, attractive fees, savings and expenses monitoring, hassle-free account creation, and personalization. Neobanks are on the verge of extending measures to combat the challenges of financial inclusions and other financial services of traditional banks. With such driving features, Neobank is gradually becoming a sustainable and lucrative business model in the fintech industry. Neobank is an emerging financial tool that has an exponential demand for worldwide adoption to provide niche solutions and detangle challenges of traditional banking.
We are talking about the financial inclusion. So financial inclusion means that citizens who are excluded from the banking sector, they have not availed any products. The product may be a deposit product or advance product, or whether it is a remittance. For example, he or she is working in a different place and they need to send the money. to the family or their parents. For that, they need the remittance facility. So it may be depositing the excess fund with the bank, or getting some loan to enjoy the life, or purchase required gadgets, or purchasing any property, or purchasing any car. Some loan they may require, or a two-wheeler. So it may be deposit product, or a loan product, or a remittance, uh, or any other products also. But how the inclusion is possible? So every citizen need to open an account. How it is possible? For example, a small, uh, a villager, a farmer in a rural place. If he want to deposit some amount with a bank, he need to travel at least to 2-3 kilometers to reach the bank branch in the early stages or early ages. But now, due to the introduction of fintech, they can transfer the money, or they can get the money by using the app. That is the advantage they have got right now. So inclusion means even the rural person coming to the branch, for that they need to pay some amount for travel expense as well. If they are going to deposit 2,000 rupees, even then they need to spend some amount for travel. In addition, if they need to come to the bank branch, they need to take a leave, or they cannot work on a particular date. The incidental expenses, they may be losing the wage or salary for a particular date. That is also the expense they need to take care. So the financial inclusion is most important. Mr. Nicholas is telling banks have to upgrade themselves for risk being burned to the ground. He is a leading fintech CEO of Ally Labs Alliance, and he narrates the importance of technology, adoption of technology by banks. We are talking about financial inclusion. Financial inclusion, as you all know, it is the affordable banking facilities to all the citizens, and they should be able to avail a different type of products available in the banks. We will see a small name regarding that.
What is financial inclusion? Think about this. About half of the world's adults, or some 2.5 billion people, still don't have a bank account. That's 60% of people in developing countries versus only 11% in developed ones. Some live in rural areas too far from physical bank branches, or they think bank accounts are only for the wealthy. People who don't have bank accounts don't save, hurting their ability to make larger purchases or invest in healthcare and education. Small businesses without access to formal credit have a hard time expanding, impeding job creation. This all hurts an economy's potential. There have been attempts to deal with the problem through financial inclusion. That's the delivery of mainstream financial services at affordable costs to disadvantaged and low-income individuals. This is Mohammed Yunus. He founded microlender Grameen Bank in Bangladesh and won the Nobel Peace Prize in 2006. Many hoped microfinance, which makes loans of under $100 to fund small businesses, would bring finance to the masses. But the focus on credit also brought debt and repayment problems. Many experts say the approach has largely failed to make much of a dent on poverty. Today, policymakers are hoping technology offers a solution. Mobile phones are often more common in rural Asia than bank branches. They can be used to make simple money transfers. Experts say that could be the key to helping the poor save and build a better life, and become more financially included.
How the fintech companies can support financial inclusion? The main advantage is the most of the population are having mobile. Through mobile, through using the technology, the financial inclusion is possible. They are connecting the banks with the people by using and leveraging the technology. The definition given by World Bank. The World Bank defines financial inclusion as a condition when the individuals and businesses have access to useful and affordable financial products and services that meet their needs, transactions, payments, savings, credit, and insurance delivered in responsible, sustainable way. So it covers four main things. One is transactions, that is deposit and withdraw, and the payments to some third party, remittances, and the savings by way of a deposit, whether it is CASA, that is current account savings account, or term deposits or other things. And credit as well. The credit required for their livelihood or to enjoy the lifestyle. And the insurance to protect their family. All these things, few things may not be available directly from the bank. Sometimes bank need to tie up with the vendor. For example, insurance banks may not be having the product. In that case, they will be tying up with the insurance company for delivering the product to the public. So this is the definition of financial inclusion given by World Bank. Here they are not only covering the citizen, they are covering the business as well. Because business, they are also not getting the loans. So they are also excluded, especially this is MSME, MSE, micro and small enterprises. They are not being covered by the banks in general. There are two reasons. One, they may not be having the financials to support their income, or they don't have the knowledge how they can approach the bank as well. And another thing, there are some fraudsters also approaching the bank. So in that case, bank is not ready to give the loan. For that also, the government of India has created one scheme, CGTMRC, that is a guarantee. Those who are not able to provide the collateral, the bank, the government itself is giving the guarantee. The product is CGTMRC and the like. In that case, the borrower need not to give the collateral or security in support of the loan. Whenever the loan is failed or he is not able to repay, the bank will have the hold to sell the property and close the loan. In lieu of that, the government is giving CGTMRC cover so that the small business owners or MSEs are not given the financial support by the banks. Financial inclusion has been defined by the Committee on Financial Inclusion, chaired by Dr. C. Rangarajan, former Reserve Bank of India governor in 2008. The definition is the process of ensuring access to financial services, timely and adequate credit for vulnerable groups such as weaker sections and low-income groups at affordable cost. It covers the entire gamut of the loan, starting from any agriculture loan or any business loan or education loan. So normally they are housing loan. They are normally termed as priority sector loans. So priority means in that the development of the Indian economy is also connected. For example, we can divide the needs and wants. What is the need and what is a want? Need is a basic thing like food, shelter, and clothing. Anything beyond that comes under the head wants. So needs is called the priority. In that way, the priority thing like food, agriculture, and business or income or earning, that is MSME, that generates a lot of employment for the public. And the education, thereby they can make them eligible to get a salary job or take a business assignment, or they can start their own startup. So all these ways, Government of India is supporting by way of incentives and concessions on priority sector loans. So needs and wants is also important thing. Needs covers the basic things like food, shelter, and clothing. So timely loan need to be given. That is also very important, and adequate loan is also required to be given. If a bank is not providing adequate loan, then they need to get some loan from outsiders at an exorbitant rate to run the business. So that is also one of the important things in the financial inclusion as well. Reserve Bank of India given 6 points as their vision in financial inclusion. One is universal access to financial services. So everyone has the right to access the financial services, whether it is a deposit or loan or any other product, and providing basic bucket of financial services to enable or to support or supply the different type of products. The bank need to develop different type of products as per the um, needs of the customers or citizens. Access to livelihood and skill development. When a business is carried out, they need to have some required training or skill so that they can success in the venture. So that also need to be included in the financial inclusion. Financial literacy and education. So whenever a person is availing a loan, they should know what is the terms and condition, what is the rate of interest, what is the rate, whether it is a compound or simple, what is EMI, what is the flat rate, and other things they need to understand, because whenever the rate is mentioned as flat or whenever it is mentioned as EMI, these two things are totally different. Whether the customer is understanding all these terms, few banks or money lenders may be charging exorbitant rates. Uh, they may be misusing the financial literacy level of the customer. So it is very important for every citizen to have awareness about the financial literacy, and for that they need to have the education as well. Customer protection and grievance redress. So whenever customer is not getting the right kind of service, then they can raise their voice and they can get the grievance resolved. For that, there are many mechanisms available in India. Mostly they are regulated by Reserve Bank of India, and Government of India also enacted special laws like Consumer Protection Act or Right to Information Act, so that the citizen can get the uh, rights by using these legal means as well. And Reserve Bank of India has formed the banking ombudsman. Whenever there is the customer is dissatisfied and the service is not up to their expectations, then they can go to the banking ombudsman to resolve their issues. First, they can approach the bank, and if the complaint is not resolved, then after 1 month they can go to banking ombudsman also. So customer protection and grievance redressal, there are four things. Two things are from Government of India by way of Act, that is Consumer Protection Act and the Right to Information Act. In addition, Reserve Bank of India, banking ombudsman is also there to protect the customer. And the effective coordination of all these things are very much important to have the financial inclusion in a viable manner. How the financial inclusion is measured? There are three important subsectors are there. One is access, usage, and quality. Based on that, how financial inclusion is effectively implemented is measured. One is access. Access means customer can access the service in two ways. One is in a physical way and another one is in digital way. Digital means they can access the banking services, financial services through their mobile or internet. Physical points of sales service means they can go to the branch or they can go to ATM and they can access the banking services. Usage, formally banked account, they have to open the account, that is one thing, and adults with credit at formal institutions. For this, PMJDY is also introduced. Small amount of loan they can get for their requirements. And adults with insurance, all the family to be protected with the insurance. Cashless and mobile-based transactions, usage of plastic cards and transactions using electronic media, whether it is IMPS or RTGS or NEFT or Aadhaar-enabled payment system or payment gateway, are using the fintech as well. So these are enabling the Indian economy moves towards from less cash economy to cashless economy. So in the recent budget, you might have seen that digital currency is going to be rolled out in the coming years. And frequent of account usage. It is not just opening the account. It is how far they are utilizing the account, how far they are transacting their account. And the remittances, as already we have discussed. So some person may be working. So some person may be working in a different place and they need to send the money to the family or parents or children. Then they will be using the remittance facility. Remittance facility, a lot of facilities are now available, including NEFT, RTGS, and GPay or ATM, whatever means they can send it. That is a usage. Then quality of the financial inclusion will be measured how far the citizen are knowing or having the literacy in the financial matters. In the coming up slides, you will see a few questions as well. So whether we are having the financial literacy, the citizens are having financial literacy, that is more important. That is also one of the measures to evaluate how far financial inclusion is implemented. Then the grievance redressal that we have already discussed. Broad indicators to measure access to financial services. These are a yardstick how far the financial services is applied in a particular country also. So number of branches per 1 lakh adults, that is one criteria. Then number of ATMs per 1 lakh adults, and the number of point of sales machines per 1 lakh adults, and number of business correspondents per 1 lakh adults. So wherever the brick and mortar branches are not available, then the concept of BCBF is introduced. BC is the banking correspondent. They will be going to unbanked places and they will do the transactions, the small transactions of receipts and payments as well. Then the broad indicators measure the usage of financial services. This is the third parameter. Percentage of adults with a savings account and formal financial inclusion. That is one parameter. Then percentage of MSMEs having access to formal credit. So there are many MSMEs, they are not availing the loan. One, they may not have the eligibility to avail the loan, or the banks may not be giving the loan. They may feel that giving loan to particular MSMEs. So both the cases. Then percentage of SMF having access to formal credit, small and marginal farmer. So these are the agriculture loans. So they should get the agriculturists. They should get the loan for their input or other things required to cultivate the crop or produce. So that is also another thing. And percentage of adults having pension policy. So pension is a social security scheme. How many citizens, how much are covered under the pension policy is also taken into account as a parameter. Percentage of adults having insurance product, that is another parameter, and percentage of adults having access to credit. Based on these parameters, every country is also listed out, and it will be followed up by International Monetary Fund and World Bank as well. The broad indicators to measure the quality of financial services, there are two things. One is financial literacy and capability. So financial knowledge score is calculated. So in India also, financial literacy programs are designed for the students studying 6th to 8th standard and 9th and 10th standard and 11th and 12th standard. 3 levels of exams will be conducted to check the financial literacy. Financial knowledge score, it is an arithmetic score which sums up the correct responses to questions. Earlier there were 3 types of questions were there. Now it is increased to 6 types of questions. Ranging, they will be covering the inflation, the knowledge about the inflation rate and the interest rate. Then compound interest, what is compound interest and how it is calculated. Then the money illusion and the risk diversification in case of investment in shares and other things, and main purpose of insurance. and all these things are covered in this financial knowledge scope. Grievance redressal, so already we have discussed. So whenever the customer is not comfortable or dissatisfied with the services, then they can raise the grievance and they can approach different authorities that we have discussed. It will be measured through how many, the number of complaints received and the number of complaints resolved. Based on that, this will be decided. And we are talking about the financial literacy. So many things are there. When we are generally talking about literate, we'll be talking about the language, or whether he is able to write, read, and other things. In case of computer literate, also the terms are used, whether they can comfortably operate the computer system and other gadgets. And regarding the financial inclusion also, the financial, whether we are financial literate or not, there are few questions formulated, and based on that, a survey also conducted. To measure financial literacy in the US, Olivia Mitchell and Anna Maria Luzardi designed a survey. It consists of 3 basic questions. Yeah, later, it was expanded to 5. We will see few of them here. Suppose you had rupees 100 in savings account and the interest rate was 3% per year. After 5 years, how much you will have? This is the sample question. Am I audible?
Yes, sir.
Okay, thank you. So there are 4 options available. More than 103 or exactly 103 or less than 103. If you can use chat box, you can give answers, or else I will give answer. So interest calculation, it is basic interest calculation. 3% per year means at the end of the year it will be 103. Then next year it will be 106 plus, then 109 plus, like this it will go. So the answer will be more than 103. But usually what the respondents, they have given wrong answer also. So that you will see in the end of the slide. Then imagine that interest rate on your savings account was 3% per year and inflation was 7% per year. After 1 year, how much would you be able to buy with the money in this account? Whether it will be more than today or exactly the same or less than today. Here the inflation rate given was 7%, but the savings account deposit rate was 3%. So if I have 100 rupees this year, it will be 103 rupees after adding the SB interest. Whereas my money lost minus 7%. So 100 minus 7. So the difference will be minus 4. So it will be less than today. And a question on risk, it is a true or false. Buying a single company stock usually provides safer return than stock mutual fund. So here the respondent has to understand what is stock and what is mutual fund. And if you may think that blue chip companies or reputed companies, when I invest, I will get more return. But that will not be the case always. Whereas in stock of mutual fund, it will be diversified. For example, different industries and different companies, the shares will be invested. For example, if the shares are invested in 100 companies, at a single point of time, all the companies will not fail. And if 30% of the company fail also, 70% return they will get. So investing in the mutual fund is better than investing in single company stock. Then on bond price, if interest rate rises, it will be what will typically happen to bond prices. The options are they will rise, they will fall, and they will stay in the same. So the answer is they will fall because it is having inverse relationship. with the interest rates. That is why bond price will fall. This is regarding mortgage. 15-year mortgage typically requires higher monthly payments than 30-year mortgage, but the total interest paid over the life of the loan will be less. True or false? The answer is true. A 15-year mortgage, the interest may seem to be higher, but it will be paid within 15 years. But in 30 years, the interest EMI will be lesser, but they need to pay for 30 years. When we compare it, the 15-year mortgage typically is better. And even though the monthly payments will be higher, at the end of calculating the interest at the tenor, and it will be surely less than 30-year mortgage. So based on the first three questions, that is a compound interest and inflation and risk diversification, the survey was conducted by the World Bank, and the survey report is given here for your reference. In India, it happened in 2006. We can see that compound interest, almost 60% of the respondents given the correct answer, whereas the average was, the global average was around 55%. Indian the respondents got better average. Whereas in the question number 2 regarding the inflation, the world average was nearly 60%, whereas Indian average was around 25%. So they are not understanding the inflation. That is the thing inferred in this question. Risk diversification, that is regarding the investments, the average is very less in India. This is the survey taken by World Bank in 2006. So the 6 pillars of financial inclusions, these are nothing but the vision already we have discussed. Universal access to financial services, providing basic bucket of financial services, access to livelihood and skill development, and financial literacy and education, and consumer protection grievance, redressal, and effective coordination. So first thing, product should be eligible and it should be accessible. Then earning facilitation need to be taken care. Then they need to have the good financial literacy and education as well. Whenever the service is not expected more or the customers are dissatisfied, there should be mechanism for grievance redressal. But all these things, the bottom up thing is leveraging the technology and adopting multi-stakeholder approach for sustainable financial inclusion. There comes the need for fintech companies. United Nations identified 17 Sustainable Development Goals, shortly known as SDGs. One is no poverty, then zero hunger, good health and well-being, good quality education, gender equality, clean water and sanitization, affordable and clean energy, decent work and economic growth, industry innovation and infrastructure, required inequalities. This is there should not be any customer discriminated on anything, and sustainable cities and communities, responsible consumption and production, climate action, life below water, so stop plastics, then life on land, the ecosystem should not be affected, the environment should be protected, peace and justice, and strong institutions, and partnership for goals. Out of these 17 sustainable developments, 7 sustainable development goals are influenced by the financial inclusion. That is a very important thing we need to know. Ignoring technological change in a financial system based upon technology is like a mouse starving death because of someone moved their cheese. You might have heard and read the book, Who Moved My Cheese? There are 4 characters in that book, the 2 women beings and 2 rats, and every day they are eating the cheese. One fine morning they found that there is no cheese. Likewise, it may happen if the bank is not adopting the technology or leveraging the technology. One day bank may vanish. This is the words of Mr. Chris Skinner. He is author of Digital Banking, one of the best seller. Here we need to understand banking as a platform. Earlier, banking was not thought of a platform. So what is a platform then? So platform means here not only our own products we can market or sell other products as well. So earlier banks were dealing their own product, then they started selling the insurance product and the health insurance product and wealth management products like uh, mutual funds or a systematic investment plan and other things. So banking as a platform. So what we are connecting? We are connecting the two set of people. One people having the uh, excess funds or cash, and another set of people who want funds or cash. So here in this platform, they can meet and they can exchange the product. So here the bank is facilitating. Now we need to understand what is BAS and SaaS. BAS means banking as a service, and SaaS is software as a service. When the BASS is collaborating with SaaS, there emerges the fintech. So fintech is utilizing the services of finance and leveraging the technological facilities. Now, when we are talking about the fintech, when it has emerged, there are two school of thought. They are thinking, one school of thought, they are thinking that the fintech started only in the recent past, probably after 2000. But there is another school of thought. They are telling it started in 1800. So you'll see them. So the two school of thoughts are handling different kinds of views. In fintech 1.0, transatlantic cable started, then telegraph, Morse code started. In fintech 2, advent of cards, ATM, that is a debit card and credit card and ATM cards, and the rise of e-commerce has started. In fintech, today it is happening, it is 3 or you can say 3.5 or 4 also. So Bitcoin started in 2009. The emergence of fintech in the developing countries also taken. So the years here it is divided in fintech 1 as 1865 to 1966, then 2 1967 to 2008, then 3 2008 to 2014, and 3.5 2014 to 17, and 4 it is 2018 to till now. So in 1860, a device called pen telegraph was developed to verify the signature by the bank. So here fintech, it is meant that the technology is used for the financial transactions or by financial company. And 1866 first valid fintech footprints happened and transatlantic cables were installed. The telegraph were done. It is connecting between, it was connecting two countries. There is Great Britain and America at that time. And electronic fund transfer through telegraph and Morse started in 1988. So telegraphic transfers. Then a book was published in Economic Consequence of Peace in 1919. That is the first fintech-driven future that they have touched upon. Then credit card also issued by Amex in 1958, and Diners card issued in 1950. And second phase, that is fintech 2.0, started in 1967 and it extended up to 2008. The ATM machine were introduced by Barclays in 1967, and telex replaced the telegraph in the year 1966. And NASDAQ, the first electronic stock exchange market, was opened in 1971. And SWIFT, the messages sent for international transactions, started in 1973. And E-Trade was started, and similar to core banking solution, MBS was started, that is online banking for customers in US in 1983-85. and many technological innovations started in 1998. PayPal was also launched. In FinTech 3, 2008 to 2014, another school of thought is telling this is the FinTech 1.0. So 2000, after the crisis of 2008, many technology were used for protecting the banks, and Bitcoins were developed in 2009. P2P payment system started in 2011. Many technology were used like BAS, or registered digital lending, InsurTech, and wallets were started operating. The year 2014 onwards, a lot of changes happened, and the most populous countries like India and China were leading. Right now, the penetration of fintechs in India is around 87% and topping the world countries. So in the fintech ecosystem, lot of different type of fintechs are available. For lending, they are taking care. Blockchain and crypto, they are taking care. Regarding the registration, that is registered. Then personal finance, lending apps are there. Payments and billing, then insurance, insurtech, and capital market, wealth tech, wealth management, funds transfer and remittances and mortgages. So different type of fintech companies are in the ecosystem, and each and every one are affecting the performance and the survival of another fintech. This is a comparison chart starting from 2015 to 2019. So leading fintech categories are money transfer and payments, that was leading throughout all the 3 years. And savings and investment, that occupied the first position in 2015, and 2017 onwards it is occupying the third position. Whereas insurance, that was occupying fourth position, has to come to the second position in 2017 and 19. Borrowing is still occupying the last position in this category. So FinTech Valley is one of the innovative things started in Vizag to cater and handhold the FinTech companies.
If money makes the world go around, technology is making it go around faster. The convergence of finance and technology is revolutionizing the world of business. Started in 2016, the FinTech Valley in Vizag aspires to be an innovation hotspot.
As the new era of technology,
Global FinTech investments are growing at a rapid clip.
Banking has to work when and where you need it, and the best advice and best service in financial service happen in real time based on the customer behavior, and using the principles of big data and gamification. This is the words of Brett King, CEO of Morgan, New York. So we need to understand our customers, whatever be the business. Our customers, when we divide by the age group, from 1946 to 1964, those who are born in between 1946 and 1964, they are known as baby boomers. And 1965 to 1979, Generation X. And 1980 to 94, it is millennials. It is 1995 to 2012, iGen. There are distinctive characteristics between these group of customers that we need to understand. For example, iGen, you don't have to tell anything about digital. For example, if I give my mobile phone to a 2-year-old small kid or child, and he or she can operate it very well, even though I may not operate in that speed. So that is a different thing. They are very much comfortable with operating with the digital gadgets. And the millennials and Generation X, they have started understanding the digital and computer things. Based on that, they are adapting to the technology. So this is very much needed when we are introducing or leveraging on the fintech. So here we need to understand who is the native and who is the immigrant. The person who was born between 1995 or afterwards, they are known as iGen and they are known as natives, digital natives. So other people other than this iGen are known as immigrants. Immigrant means even though they have not born when the computer or other systems are available, and they started learning and adapting to that. If bank can offer something more valuable than Amazon Prime, we are probably in the wrong business. So this is Rami Nazar. So he is an engineer, author, designer, and maker. He has written 2 books. They are bestsellers on artificial intelligence and machine learning. So fintech applications, they are connecting with the bank that we have already discussed, and bank's main business, as by definition, accepting deposit from the public and lending and making investment. In addition to that, bank will do para-banking business also, like selling insurance and other products. So here the bank need to know who is the competitor. Some 5 or 10 years back, I never thought post office will be a competitor. Now post office is operating as a payments bank. Facebook now giving MSME loans, and they have started. And WhatsApp, I thought that it is a messaging app, but now they are also competing to the bank. Amazon, you know very well, they are also acting as a payment gateway in the payments app. Google Pay and Paytm and other things. So here I need to know who are all my competitors, and all these are, most of these companies are fintech companies affecting my performance. They are the disruptors. So when they are affecting my business, I need, if I am not able to compete with them, I need to collaborate with them. So you'll see a small AV on that.
If you've ever paid for something with your phone, transferred money using an app, or checked your bank statement online, then you're already part of a multi-billion-dollar industry. It's called fintech, and it's changing economies around the world. Fintech is short for financial technology. Seems simple, right? Well, the term fintech includes a huge range of products, technologies, and business models that are changing the financial services industry. It refers to everything from cashless payments to crowdfunding platforms to robo-advisors to virtual currencies. So every time you donate to someone's Kickstarter campaign, that's fintech. Or if you transfer money to someone using Venmo, that's also fintech. And that's just the beginning. Here at a major fintech conference in Amsterdam, hundreds of companies are trying to disrupt the banking and finance industries by changing the way we pay and borrow money. And investors are buying it. Global investment in the fintech sector has added up to nearly $100 billion since 2010. In 2017 alone, fintech investment surged 18%. Startups focusing on payment and lending technologies received the majority of those funds. It's not just startups that are getting into fintech. Some of the world's biggest companies, from Apple to Alibaba, are going big on it too. Just think of Apple Pay or Alipay. One reason for all of this investment, consumers are adopting fintech fast. 1 out of every 3 people across 20 major economies report using at least 2 fintech services in the last 6 months. China and India are leading the way, with more than half of consumers using services like money transfers, financial planning, borrowing, and insurance. Financial technology has filled a void for people around the world who don't have access to traditional banking services. In fact, it's estimated nearly 2 billion people worldwide are without bank accounts. Now, thanks to fintech, all you need is your phone to take out a loan or insurance. Take Kenya, which pioneered a mobile banking system called M-Pesa. Kenyans access their M-Pesa accounts directly on their mobile phones to transfer money, pay bills, or take out loans. Today, an estimated 96% of households in Kenya use M-Pesa. And one study found it has helped lift roughly 2% of Kenyan households out of extreme poverty. The rise of fintech has forced traditional lenders, insurers, and asset managers to embrace new digital technologies. For example, wealth managers now have to compete with robo-advisors, which are automated financial planning services. I mean, talk about rise of the robots, right? Thanks to high-tech algorithms, these services are available 24/7 and can be more affordable than traditional asset managers. That helps explain why some robo-advisors already have billions of dollars under management. Like any growing industry, fintech isn't without risks, and some regulators have struggled to keep up with the fast pace of innovation. Think of peer-to-peer lending platforms, where individuals borrow and lend without going through a bank. Compared to traditional banks, These services might not be required to set aside as much money in case customers default on their loans. This can be risky for companies and consumers. Data privacy is another major concern. As more financial services go digital, cyber attacks become a bigger risk. The challenges facing financial technology are likely to grow as more businesses go digital. But for many of the companies and consumers here, fintech is more than a buzzword. It's a big business opportunity.
So this already we have discussed. If I'm not able to compete, I need to collaborate with. That is the thing what is happening. So a lot of technologies are interrupting and they are going to interrupt. And the use of big data, now we are moving from big data to good data. Which data is best for me to understand my customer, their character, what they want, and everything I can understand by using the big data analytics. So some people call this artificial intelligence, but reality is technology will enhance us. So instead of artificial intelligence, I think we will augment our intelligence. Ginny Rometty, CEO of IBM. And the emerging technologies also used for the best use at the bank, leveraging the technology, artificial intelligence and machine learning, distributed ledger technology or blockchain technology are used for ease of operation and customer experience by utilizing the services of fintech companies. The web, as I envisaged it, we have not seen it. The future is still so much bigger. That is applicable to fintech also. So a lot of things are coming up and it is going to rule. So how the future will be there? Surely it will be leveraging on the technology. So technology, with the support of technology, the financial products will reach all the people and all the citizens. So 100% financial inclusion is possible only with the support of technology. So the future, how it is going to be. This is a report of KPMG.
The world has changed. Throughout the global COVID-19 pandemic, banks have played a vital role, supporting employees, enabling communities, and working with governments and regulators to keep economies moving. Trust has been at an all-time high, and maintaining this momentum means understanding where the future is headed. The challenges to navigate are apparent. Looming economic uncertainty, historically low interest rates, mounting liquidity and credit losses, along with greater regulatory scrutiny and remediation costs. Those who succeed are likely to generate new growth, build resilient operating models, drive innovative experiences, and sustain better ways of working. Success is powered by understanding the bigger picture. At KPMG, we have identified 6 macro trends driving the new reality. New distribution channels reconfigure the landscape. Digitization shakes up products and services. The shift to a digital economy accelerates. Cost priorities are reimagined. Automation enables growth without compromising resilience. Risk is rewritten across the spectrum, with cyber and third-party risk dominating. Long-term, mass-flexible working is here to stay, and there's a greater commitment to climate and society which drives customer loyalty as values and purpose take centre stage. These trends are shaping banking in real time. To win the future, embrace them now.
So few references I have given for your further information and knowledge. And the digital technology is going to rule the world. We all know very well. And fintech is going to do a lot of things. Now they are going to use the artificial intelligence and machine learning, as well as the blockchain technology to the maximum use. And fintech 3.0 will be tremendously using the emerging technologies. Thank you, everyone.
Thank you. Thank you, sir, for your valuable speech. Your address was enlightening, entertaining. It helped us to enhance our knowledge on the various schemes and incentives provided by the government, the timeline for the growth of fintech, and much more. The future of fintech was also very much useful for us, sir. Thank you, sir. Thank you so much.